Welcome to Finance Frontier AI, your ultimate guide to the intersection of finance and AI. Broadcasting from the heart of Chicago, a city renowned for its towering skyline and rich financial history, we dive into the latest trends and developments shaping the future of these two powerful sectors. This episode is titled Revolutionizing Finance and AI from Chicago's historic financial hub.
Today, we're not just talking about any city, we're talking about Chicago, home to the iconic Chicago Board of Trade. This historic financial landmark has been a cornerstone of American finance since 1848, symbolizing innovation and resilience. It's a fitting backdrop as we explore how AI is revolutionizing the financial industry.
The Chicago Board of Trade, with its magnificent Art Deco architecture, isn't just a building. It's a testament to the evolution of financial markets. From trading grains in the 19th century to the complex financial instruments of today, it's seen it all. And now, as AI technologies emerge, we stand at the brink of another transformative era.
In today's episode, Revolutionizing Finance and AI from Chicago's historic financial hub, we have a jam-packed agenda that you won't want to miss. We'll start with the latest finance and AI news, covering everything from the recent downturn in semiconductor stocks to groundbreaking advancements in AI technology. We'll also dive into the rotation from megacap to small-cap stocks, highlighting why this shift is crucial for savvy investors.
We'll delve into major developments like Nvidia's investment in Serve Robotics and the significant financial stress signals from U.S. banks. Plus, we'll explore innovative AI-driven investment strategies and tools that are changing the game for both retail and institutional investors.
And for those looking to make money with AI, our trading and investment segment will provide actionable insights on promising stocks like DeFi Technologies Incorporated. We'll analyze market trends, share our top picks, and offer expert advice to help you stay ahead of the curve.
We'll also continue our Finance and AI series with an in-depth look at infrastructure investments and AI's role in environmental sustainability. These topics are not only timely, but also vital for understanding the future landscape of finance and technology.
Finally, our business idea segment will inspire you to think big with a concept for an AI-driven environmental solution startup. We'll outline the steps to launch and scale this innovative business, highlighting its potential for significant financial returns and positive environmental impact.
We've got all this and much more coming up. To ensure you never miss an episode, subscribe to Finance Frontier AI on Apple Podcasts or Spotify. Your subscription helps us climb the charts and reach more listeners, expanding our community of finance and AI enthusiasts.
And don't forget to follow us on Twitter for live updates. We post about new trades and investment opportunities when we see them, focusing on small-cap stocks with at least 50% upside and swing trades in ETFs when we identify good setups.
Stay tuned as we dive deep into the world of finance and AI. Live from Chicago. Let's uncover the future together.
Welcome to Chapter 1, Top Finance and AI News. Today, we're covering some significant events that have recently made headlines in the finance and AI sectors, impacting cities like Chicago. What's our first story?
Our first story is about the Federal Reserve officials indicating they are nearing a decision to cut interest rates by the end of 2024. According to Reuters, this potential rate cut could have significant impacts on various sectors, particularly housing and financial services in major cities like Chicago.
A rate cut could stimulate economic growth but also affect inflation rates. It's something that could really move the markets in a city like Chicago, where financial activities are so prominent. Can you provide more context on how this could impact the broader economy?
When the Federal Reserve cuts interest rates, it generally lowers the cost of borrowing for consumers and businesses. This can lead to increased spending and investment, which boosts economic activity. For example, lower mortgage rates might encourage more people to buy homes, which would benefit the housing market in Chicago. Similarly, businesses might take advantage of cheaper loans to expand their operations or invest in new projects, which can lead to job creation and economic growth.
That makes sense. But there's also the risk of inflation if the economy overheats, right?
Exactly. If the economy grows too quickly, it can lead to higher prices as demand outstrips supply. This is why the Federal Reserve has to carefully balance stimulating growth with keeping inflation in check. In the case of Chicago, a city with a diverse economy that includes strong finance and technology sectors, the impact of a rate cut could be quite significant. It could boost consumer spending and business investment, but it could also lead to rising prices if not managed properly.
Another important aspect to consider is how this rate cut could affect different demographics. For instance, younger people looking to buy their first home might find it easier to get a mortgage, while older individuals relying on fixed income investments might see lower returns. It's a complex issue with many moving parts.
Speaking of market reactions, our next story is about the semiconductor sector. Shares of major chipmakers like Nvidia, ASML, and TSMC tumbled, pulling the stock market down to its worst day in months. Yahoo Finance reports this was triggered by U.S. trade tensions with China and comments made by former President Trump about Taiwan. This shows how geopolitical issues can have a direct impact on finance and technology sectors.
The semiconductor industry is crucial for many sectors, including finance, AI, and consumer electronics. When there's uncertainty or negative news in this industry, it can have a ripple effect across the entire economy. For example, Chicago is home to many tech companies that rely on semiconductors for their products and services. A downturn in this sector can impact their operations and profitability.
It's interesting how interconnected these industries are. Former President Trump made comments about Taiwan, suggesting that the country should pay the United States for its defense, and accusing it of stealing business from U.S. semiconductor companies. Taiwan is home to TSMC, the largest contract chipmaker in the world. These comments led to a sharp drop in TSMC's U.S.-listed shares and contributed to the overall decline in semiconductor stocks. This kind of geopolitical tension can create significant market volatility, as investors react to the potential implications for global trade and supply chains.
The tech sector, including companies in Chicago, can be very sensitive to these kinds of geopolitical issues. Additionally, this event underscores the importance of supply chain resilience and diversification. Companies need to think strategically about how to mitigate risks associated with geopolitical tensions.
Exactly. Diversifying supply chains and investing in domestic manufacturing capabilities can help companies reduce their reliance on specific regions. This is particularly relevant for tech companies in Chicago, which might look to reduce their exposure to global supply chain disruptions.
Moving on to cybersecurity, CrowdStrike had a major global outage after a routine update went wrong. Reuters suggests the issue stemmed from skipped checks during the update process. This incident really underscores the importance of rigorous update protocols, especially in tech hubs like Chicago.
Cybersecurity is so critical, and an incident like this can have far-reaching consequences. CrowdStrike is a leading cybersecurity firm, and they provide services to many high-profile clients around the world. The outage was caused by a routine update that was intended to enhance security protocols, but some checks were skipped, leading to widespread disruptions. This incident highlights the potential risks associated with AI and automated systems. While these technologies can significantly enhance security and efficiency, they also introduce new vulnerabilities if not properly managed. For businesses in Chicago, especially those in the finance and technology sectors, ensuring robust cybersecurity measures is paramount.
The integration of AI and cybersecurity is a double-edged sword. While it can improve threat detection and response times, it also requires rigorous oversight to prevent incidents like this.
One of the broader implications of this incident is the importance of having contingency plans in place. Companies need to be prepared for the possibility of system failures and have protocols to quickly address and mitigate the impact of such events. This is particularly important for critical infrastructure sectors like finance, where a cybersecurity breach can have severe consequences.
Finally, let's talk about Meta. They've decided to halt the release of future multimodal AI models in the European Union due to regulatory concerns. Axios highlights the complexities of navigating AI regulations across different regions, and this move could have implications for tech companies in Chicago as well.
Meta's decision underscores the challenges that tech companies face when dealing with different regulatory environments. The European Union has some of the strictest regulations when it comes to data privacy and AI. Meta, like many other tech companies, has been trying to navigate these regulations while continuing to innovate and deploy new technologies. The decision to halt the release of new AI models is likely a precautionary measure to avoid potential legal issues and fines. For tech companies in Chicago that operate internationally, this development is a reminder of the importance of staying compliant with varying regulations around the world. It also highlights the need for a harmonized approach to AI regulation to foster innovation while protecting user privacy.
The regulatory landscape for AI is evolving rapidly, and companies need to stay agile to comply with new rules. This can be particularly challenging for smaller tech firms that might not have the resources to navigate complex regulatory environments. However, it also presents an opportunity for companies that can innovate within the constraints of these regulations to gain a competitive edge.
Companies that can successfully navigate these regulatory challenges while continuing to innovate will be well-positioned to lead in the AI space. This is especially relevant for tech hubs like Chicago, where there is a strong focus on both innovation and compliance. Now let's move on to our next story.
In other news, Morgan Stanley projects that gold prices could rise above $2,600 by Q4 due to ongoing economic uncertainties and a strong dollar. This surge in gold prices indicates a growing trend among investors seeking safe haven assets amidst financial volatility.
For finance sectors in cities like Chicago, this could influence investment strategies and portfolio diversification. Gold is often seen as a safe haven asset, which means its value tends to rise when investors are worried about other areas of the market. With current economic uncertainties, including inflation and geopolitical tensions, many investors are turning to gold to protect their portfolios.
It's interesting to see how different assets perform under various economic conditions. The surge in gold prices suggests that investors are looking for stability in an uncertain market. How might this trend affect local investors in Chicago?
For local investors in Chicago, the rising gold prices could lead to increased interest in precious metals as part of a diversified investment strategy. Financial advisors might recommend adding gold or gold-related investments to clients' portfolios to hedge against market volatility. Additionally, companies involved in the trading and storage of precious metals might see a boost in business as demand increases.
Another aspect to consider is the impact on mining companies and related industries. Higher gold prices can lead to increased investment in gold mining operations, which can benefit companies that supply equipment and services to the mining sector. This can have a positive economic impact on regions involved in these industries.
Speaking of investments, Starbucks shares surged following news that Elliott Management took a sizable stake in the company. This strategic move by Elliott Management highlights the potential for increased shareholder value and strategic shifts within Starbucks.
Activist investors like Elliott Management often push for changes that they believe will increase shareholder value, such as cost-cutting measures, strategic acquisitions, or changes in management. For investors in Chicago, this development underscores the importance of monitoring activist investments and their impact on major corporations.
It's fascinating to see how activist investors can influence the direction of large companies. While it's still early to say for sure, Elliott Management might advocate for a variety of changes at Starbucks. These could include streamlining operations to reduce costs, expanding into new markets, or focusing on digital transformation initiatives to enhance customer experience. For investors, these potential changes could lead to increased profitability and, consequently, higher stock prices.
Another potential area of focus could be sustainability initiatives. As consumers become more environmentally conscious, companies like Starbucks might look to enhance their sustainability efforts to attract and retain customers. This could involve initiatives such as reducing waste, sourcing ethically, and investing in renewable energy.
Sustainability is becoming increasingly important for consumers and investors alike. Companies that can effectively integrate sustainability into their business strategies are likely to see long-term benefits.
Another major story is China's economic outlook following a key policy meeting. According to Reuters, the meeting left foreign firms uncertain about the direction of China's economic policies.
China's economic policies have a significant impact on global trade and investment strategies. For firms based in finance hubs like Chicago that have substantial exposure to Chinese markets, This uncertainty could lead to increased volatility and risk.
How might this uncertainty affect businesses in Chicago?
For businesses in Chicago that trade with or invest in China, this uncertainty could lead to more cautious strategies. Companies might delay investments or expansion plans until there's more clarity on China's economic policies. Additionally, firms might look for alternative markets to mitigate risks associated with their exposure to China.
Another consideration is the impact on supply chains. Many companies rely on China for manufacturing and raw materials. Uncertainty in China's economic policies could disrupt these supply chains, leading to delays and increased costs.
Companies will need to assess their supply chain vulnerabilities and consider diversifying their sources to reduce dependence on any single market. This is especially important for tech companies in Chicago that might rely heavily on Chinese suppliers.
Another interesting development is the trend in mortgage rates. They've hit a 4-month low, which is prompting a lot of homebuyer activity. This could significantly impact the housing market and related financial services in cities like Chicago.
Falling mortgage rates are encouraging more buyers to enter the market, potentially driving up demand and influencing local real estate investment strategies. For investors, understanding these trends can help them make informed decisions about where to allocate their resources.
What are some potential risks associated with this trend?
One potential risk is that increased demand could drive up home prices, making housing less affordable for some buyers. Additionally, if mortgage rates start to rise again, some buyers might find themselves unable to afford their new homes, leading to financial strain. It's important for investors and homebuyers to consider these risks and plan accordingly.
It's always important to consider both the opportunities and risks when making investment decisions. Thanks for all the insights today.
You're welcome. These stories really show just how interconnected and impactful developments in finance and AI can be, especially in major cities like Chicago.
Welcome to Chapter 2, Major Developments. In this segment, we'll discuss some of the significant advancements and innovations that are shaping the finance and AI landscape. Let's dive right in. What's our first major development?
Our first major development is the groundbreaking progress in AI's ability to predict Alzheimer's disease progression. According to Medical News Today, a new AI tool can predict the progression of Alzheimer's with 3 times the accuracy of current clinical methods. This is a monumental step forward in the field of medical AI.
The ability to predict disease progression with such accuracy can revolutionize patient care and treatment planning. For medical institutions and research centers in cities like Chicago, this development could lead to significant advancements in how we approach neurodegenerative diseases.
Absolutely. The implications are profound. Early and accurate predictions allow for more tailored treatment plans, potentially slowing the disease's progression and improving the quality of life for patients. This also opens up new avenues for research and funding in the biotech sector.
This development highlights the growing importance of AI in healthcare. For investors, this could signal a lucrative opportunity to invest in AI-driven healthcare startups and established biotech companies. The intersection of AI and healthcare is certainly a space to watch.
Next, let's talk about Nvidia's recent investment in Serve Robotics. According to Yahoo Finance, Nvidia invested $4 million in Serve Robotics, a company developing AI-driven delivery robots. This investment caused Serve Robotics stock to surge by 241%.
The potential for AI-driven robots to revolutionize last-mile delivery is immense. For urban logistics in cities like Chicago, this could mean more efficient and cost-effective delivery solutions.
The success of Serve Robotics could pave the way for more AI-driven innovations in logistics, creating new opportunities for investors and businesses. This is a space that will likely see continued growth and development in the coming years.
Speaking of investments, let's discuss the recent trends in oil prices. Reuters reports that oil prices have slipped due to a strong dollar and concerns about China's economic outlook. This has broader implications for the global economy and investment strategies.
Oil price fluctuations can significantly impact various sectors, including transportation, manufacturing, and energy. For a city like Chicago, which has a diverse industrial base, Changes in oil prices can affect operating costs and profit margins for many businesses.
Additionally, fluctuating oil prices can influence consumer behavior and spending. Higher oil prices can lead to increased costs for goods and services, reducing disposable income and spending. Conversely, lower oil prices can boost consumer spending and stimulate economic growth.
Investors should also consider the impact on energy stocks and related investments. Companies involved in oil production and distribution may see their stock prices fluctuate with changes in oil prices. Diversifying investments to include renewable energy sources can help mitigate some of these risks.
Another significant development involves Goldman Sachs challenging the Federal Reserve's requirement to hold additional capital following the latest stress test results. CNBC highlights the broader tensions between regulatory bodies and financial institutions regarding capital requirements and financial stability.
This move by Goldman Sachs reflects the ongoing debate over how much capital banks should hold to ensure financial stability, without stifling their ability to lend and invest. For financial institutions in Chicago, this issue is particularly relevant as they navigate the regulatory landscape and strive to maintain profitability.
The outcome of this challenge could have significant implications for the banking sector. If Goldman Sachs succeeds, it could lead to changes in how capital requirements are set and enforced, potentially impacting the entire industry.
It also underscores the importance of robust regulatory frameworks that balance financial stability with the need for banks to support economic growth. For investors, staying informed about regulatory developments and their potential impact on financial institutions is crucial.
Finally, let's discuss Meta's decision to halt the release of future multimodal AI models in the European Union due to regulatory concerns. Axios highlights the complexities of navigating AI regulations across different regions, and this move could have implications for tech companies in Chicago as well.
Meta's decision underscores the challenges that tech companies face when dealing with different regulatory environments. The European Union has some of the strictest regulations when it comes to data privacy and AI. Meta, like many other tech companies, has been trying to navigate these regulations while continuing to innovate and deploy new technologies. The decision to halt the release of new AI models is likely a precautionary measure to avoid potential legal issues and fines.
For tech companies in Chicago that operate internationally, this development is a reminder of the importance of staying compliant with varying regulations around the world. It also highlights the need for a harmonized approach to AI regulation to foster innovation while protecting user privacy.
The regulatory landscape for AI is evolving rapidly, and companies need to stay agile to comply with new rules. This can be particularly challenging for smaller tech firms that might not have the resources to navigate complex regulatory environments. However, it also presents an opportunity for companies that can innovate within the constraints of these regulations to gain a competitive edge.
Companies that can successfully navigate these regulatory challenges while continuing to innovate will be well-positioned to lead in the AI space. This is especially relevant for tech hubs like Chicago, where there is a strong focus on both innovation and compliance.
To further discuss the impacts of these developments, let's delve into how each one could potentially reshape the future of finance and technology.
The AI tool predicting Alzheimer's progression, for instance, has the potential to transform healthcare financing. As precision medicine becomes more mainstream, insurance companies may adjust their models to incorporate AI-driven diagnostics, leading to more personalized healthcare plans and potentially lower costs for patients.
And Nvidia's investment in Serve Robotics highlights the ongoing shift towards automation and AI in everyday tasks. For financial markets, this could mean increased investment in AI startups, with Chicago being a prime location for such ventures due to its robust tech ecosystem and financial infrastructure.
The fluctuating oil prices also present a dynamic landscape for investors. Cities like Chicago, with their diverse economies, will need to adapt to these changes. Energy companies might increase their focus on renewable sources, which could lead to new investment opportunities in green technology.
And the Goldman Sachs challenge to the Federal Reserve's capital requirements is a reminder of the delicate balance between regulation and growth. Financial institutions in Chicago and beyond must navigate these changes carefully, ensuring they can continue to lend and invest effectively while maintaining stability.
Finally, Meta's regulatory challenges in the EU highlight the global nature of AI development. For tech companies in Chicago, this means staying ahead of regulatory trends and being prepared to adapt their strategies to comply with international standards.
These developments collectively underscore the importance of staying informed and adaptable in the fast-evolving fields of finance and AI. Whether you're an investor, a business leader, or a tech enthusiast, understanding these trends is crucial to navigating the future successfully.
Absolutely. Stay tuned as we continue to explore the cutting-edge intersections of finance and AI. Welcome to Chapter 3 of our podcast, where we delve into practical strategies for trading, investing, and making money with AI. Today, we'll explore various investment opportunities, the latest trading strategies, and how AI is revolutionizing the financial landscape. Let's get started. What's the first topic on our list?
Our first topic is the integration of AI in investment banking. According to TipRanks, major players like Goldman Sachs and Morgan Stanley are leveraging AI to enhance their trading strategies and investment analysis. This is revolutionizing how investment banks operate and compete.
AI-driven analytics can process vast amounts of data much faster than humans, leading to more informed and timely investment decisions. For investment banks in a financial hub like Chicago, this could be a game changer.
Absolutely. AI's ability to analyze market trends, predict price movements, and optimize trading algorithms can significantly improve profitability. Investment banks are also using AI to identify new investment opportunities and manage risks more effectively.
Speaking of investment opportunities, we have some live tweets from financial experts discussing AI-driven investment strategies. Here's one from @Finance Guru: AI algorithms are identifying undervalued stocks faster than ever. Don't miss out on the next big opportunity. #AI, #investing, #finance.
AI tools can scan the market for undervalued stocks and make investment recommendations based on real-time data. This is particularly beneficial for individual investors who might not have the resources to conduct such in-depth analysis on their own.
Another tweet from @MarketMaven highlights the impact of AI on risk management. AI-driven risk management systems are helping firms navigate market volatility with greater confidence. #AI, #risk management, #finance.
Risk management is crucial in trading and investments. AI systems can analyze vast amounts of data to identify potential risks and suggest mitigation strategies. This allows investors to make more informed decisions and protect their portfolios from unexpected market shifts.
Moving on, let's discuss predictive analytics in trading. AI's ability to predict stock market trends and price movements is a significant advantage for traders. According to recent reports, AI algorithms are becoming increasingly accurate in forecasting market behavior.
Predictive analytics can give traders a competitive edge by providing insights into future market trends. This helps them make strategic trades and maximize their returns. For example, AI tools can analyze historical data, current market conditions, and even news sentiment to predict how stocks will perform.
And what about automated trading systems? These AI-driven systems are transforming the financial markets by executing trades based on preset criteria. This reduces the emotional bias that often affects human traders.
Automated trading systems can operate 24/7, making trades based on data-driven insights. This ensures that trading decisions are consistent and not influenced by human emotions. For institutional investors in Chicago, these systems can enhance trading efficiency and profitability.
Let's not forget the impact of AI tools for retail investors. With the rise of AI-driven investment apps and platforms, individual investors now have access to sophisticated tools that were once only available to professional traders.
These AI tools democratize investing by providing retail investors with insights and recommendations tailored to their specific goals and risk tolerance. This empowers more people to participate in the financial markets and make informed investment decisions.
Speaking of retail investors, DeFi Technologies Incorporated, DEFTF, has been making waves in the decentralized finance space. Let's dive into why this stock is gaining attention and how it's leveraging AI.
DeFi Technologies Incorporated is at the forefront of the decentralized finance revolution, providing innovative financial services and products centered around digital assets. One of their key partnerships is with CoinMarketCap, which enhances their market visibility and credibility.
They also launched the Valor Hedera HBAR ETP on the Bourse Frankfurt exchange, which allows investors to gain exposure to Hedera Hashgraph through an exchange-traded product. This is a significant milestone for the company.
Another innovative product from DeFi Technologies is the Yield-Bearing Bitcoin BTC ETP, offering a 5.65% yield to German investors. This product not only provides exposure to Bitcoin but also generates income, making it attractive to a broad range of investors.
Financially, DeFi Technologies is showing impressive growth. Their revenue projections increased from $7.81 million in 2023 to $62.17 million in 2024, and further to $132.76 million in 2025. This growth is driven by new product launches, geographical expansion, and increasing inflows into their ETPs.
Additionally, the company is expected to shift from negative earnings to a positive EPS of 21 cents in 2024 and 30 cents in 2025, indicating strong profitability potential.
Analysts have set a one-year price target of $2.05 for DEFTF. However, given the projected growth, this target might even be conservative, suggesting potential for a higher valuation.
Now let's talk about the recent market trends showing a notable rotation from overvalued megacap stocks to undervalued small-cap stocks. This is significant because it reflects investors' search for growth opportunities and value in smaller, potentially more agile companies.
As megacap tech stocks face valuation pressures, investors are increasingly turning to small-cap stocks that offer greater growth potential and are perceived as better positioned to benefit from potential Federal Reserve rate cuts.
Historically, small-cap stocks have outperformed during periods of economic recovery and market rotation. Tom Lee from Fundstrat highlights that small caps are poised for substantial gains, potentially outpacing the S&P 500 by at least 50% in 2024.
Small caps are expected to see faster revenue growth and higher earnings growth compared to large caps. Additionally, their lower P/E ratios make them more attractive to value-oriented investors.
DeFi Technologies' new business line, DeFi Alpha, focuses on generating yield from low-risk arbitrage trading in the digital asset space. This initiative has already generated approximately $40 million in 2024, showcasing the company's ability to leverage its excess liquidity effectively.
Their geographical expansion is also notable. Valor Incorporated, a subsidiary of DeFi Technologies, continues to expand its presence by launching new ETP products and entering new markets, including the Nordics and the Middle East.
Moreover, Valor reported a significant increase in assets under management, AUM, reaching $748 million Canadian dollars, up 47.2% this fiscal year, bolstered by strong net inflows. This growth in AUM is crucial for sustaining long-term revenue and profitability.
For investors, the potential upside for small-cap stocks like DEFTF is significant. Analysts' conservative price targets suggest there is room for higher valuations. However, it's important to consider market volatility and execution risks.
Strategies to mitigate risks while investing in small caps include diversifying your portfolio and keeping an eye on market trends and company fundamentals.
DeFi Technologies Incorporated presents a compelling opportunity for both long-term investors and short-term traders. Its innovative products, strategic partnerships, and substantial growth projections make it a stock to watch. For traders, the current setup offers an excellent risk-reward ratio, while long-term investors can look forward to significant potential returns.
To get detailed trade setups and live updates about stocks like DEFTF, follow us on Twitter. We often find small cap and penny stocks with at least 50% upside that banks and financial institutions do not cover. Stay ahead of the curve and make informed investment decisions.
Thank you for tuning in to Finance Frontier AI. Follow us on Twitter for more updates and insights. Remember to do your own research before making any investment decisions. Happy investing! Welcome to Chapter 4 of our podcast. Today, we're diving into the world of infrastructure investments. Infrastructure is a vital component of any economy, and investing in it can yield significant returns while contributing to societal growth. What exactly are we looking at in this chapter?
We're going to explore the different types of infrastructure investments, the benefits they offer, and how investors can get involved. We'll also look at some recent developments and trends in this sector.
Great. Let's start with the basics. What constitutes infrastructure investments?
Infrastructure investments refer to investments in physical assets and facilities that are essential for the functioning of a society. This includes transportation systems like roads, bridges, and airports, utilities such as water, electricity, and gas, communication networks, and social infrastructure like schools and hospitals.
These investments are crucial for economic development. They not only provide essential services, but also create jobs and stimulate economic activity. One of the key benefits of investing in infrastructure is its potential for stable, long-term returns.
Exactly. Infrastructure investments are often less volatile than other types of investments because they are backed by tangible assets and long-term contracts. They also benefit from steady demand, as these services are essential regardless of economic conditions.
Let's talk about how investors can participate in this sector. There are several ways to invest in infrastructure, from direct investments to public-private partnerships and infrastructure funds. What are the differences between these methods?
Direct investments involve purchasing and managing infrastructure assets. This requires significant capital and expertise but can offer high returns. Public-private partnerships, PPPs, involve collaboration between government and private investors to fund and manage infrastructure projects. Infrastructure funds, on the other hand, pool investor capital to invest in a diversified portfolio of infrastructure assets.
Infrastructure funds are a popular choice for many investors because they provide diversification and professional management. One prominent example is the Brookfield Infrastructure Partners, which invests in a wide range of infrastructure assets globally.
That's a good example. Another interesting development is the rise of green infrastructure investments. These investments focus on sustainable projects, such as renewable energy facilities and energy-efficient buildings, which are increasingly important in the fight against climate change.
Green infrastructure is gaining traction as governments and corporations commit to reducing their carbon footprints. Investing in renewable energy projects, like wind and solar farms, not only supports environmental goals but can also offer attractive returns due to government incentives and increasing demand for clean energy.
Speaking of trends, let's look at some recent infrastructure projects and investments. For instance, the Biden administration's infrastructure bill aims to invest over $1 trillion in U.S. infrastructure, including significant allocations for modernizing transportation systems, expanding broadband access, and upgrading water and energy infrastructure.
This bill is expected to create numerous investment opportunities. Companies involved in construction, engineering, and manufacturing of infrastructure materials are likely to benefit. Investors can also look at infrastructure-focused ETFs, which offer exposure to a broad range of infrastructure-related companies.
Another notable project is the expansion of 5G networks. Telecommunications companies are investing heavily in building and upgrading infrastructure to support 5G technology. This is creating opportunities for investors in telecom stocks and related infrastructure funds.
Investing in infrastructure requires a long-term perspective, but the potential rewards are substantial. With ongoing developments and increasing focus on sustainability, infrastructure investments offer a unique blend of stability and growth potential.
Absolutely. For our listeners interested in infrastructure investments, consider diversifying your portfolio with a mix of direct investments, PPPs, and infrastructure funds. Pay attention to emerging trends like green infrastructure and 5G expansion, as these areas are likely to see significant growth.
That wraps up our discussion on infrastructure investments. Stay tuned for the next chapter, where we dive into AI advancements in environmental sustainability. Don't forget to follow us on social media for more updates and insights. Welcome to Chapter 5 of our podcast. Today, We're exploring the exciting intersection of artificial intelligence and environmental sustainability. AI is playing a crucial role in addressing some of the most pressing environmental challenges we face today. Let's start with an overview.
AI and environmental sustainability involves using advanced technologies to monitor, manage, and mitigate environmental impacts. This includes applications in energy management, climate modeling, conservation efforts, and more. The goal is to leverage AI to create more efficient and effective solutions for environmental protection.
One of the most impactful applications of AI is in energy management. AI systems can optimize energy use in buildings, factories, and even entire cities by analyzing data and making real-time adjustments. This not only reduces energy consumption but also lowers costs and carbon emissions.
For example, Google's DeepMind has used AI to reduce the energy used for cooling its data centers by 40%. This kind of optimization can be applied to various sectors, from manufacturing to transportation, significantly reducing their environmental footprint.
Another critical area is climate modeling. AI can analyze vast amounts of climate data to predict future trends and identify potential risks. This helps policymakers and researchers develop more accurate climate models and create effective strategies for mitigating climate change.
AI is also being used in conservation efforts. Machine learning algorithms can process satellite images to monitor deforestation, track wildlife populations, and detect illegal activities like poaching. These tools provide valuable insights for conservationists working to protect endangered species and habitats.
The use of AI in agriculture is another promising area. Precision farming techniques utilize AI to analyze soil conditions, weather patterns, and crop health, enabling farmers to make data-driven decisions that enhance productivity and sustainability.
AI-powered drones and sensors can monitor crops in real time, identifying issues like pests or nutrient deficiencies early on. This allows for targeted interventions, reducing the need for pesticides and fertilizers, which can have harmful environmental effects.
Let's also talk about AI's role in waste management. AI systems can improve recycling processes by accurately sorting waste materials and identifying items that can be recycled. This increases the efficiency of recycling programs and reduces the amount of waste sent to landfills.
In urban planning, AI can help design more sustainable cities. By analyzing data on traffic patterns, energy use, and environmental impact, AI can suggest improvements in infrastructure and resource management, leading to smarter, greener urban areas.
The potential for AI in environmental sustainability is immense. As technology continues to evolve, we can expect even more innovative applications that will help us tackle environmental challenges more effectively.
For our listeners interested in this topic, consider investing in companies that are at the forefront of AI and sustainability. These include tech firms developing AI solutions for energy efficiency, agriculture, and environmental monitoring.
That concludes our discussion on AI and environmental sustainability. Stay tuned for the final chapter, where we present an exciting business idea related to today's topics. Don't forget to follow us on social media for more updates and insights. Let's dive into the steps needed to launch an AI-driven environmental solution startup and why this is such a promising idea. First, the rationale behind this concept is clear. Environmental challenges are becoming more severe, and traditional methods are often insufficient to address these issues effectively. By leveraging AI, we can create innovative solutions that are more accurate, efficient, and scalable.
The potential for AI in environmental applications is enormous. For example, AI can help monitor air and water quality in real time, predict natural disasters with greater accuracy, and optimize energy use in smart grids. These applications not only help protect the environment, but also improve public health and safety.
Now, let's discuss how to develop these AI tools. Begin by identifying specific environmental challenges that AI can address effectively. Invest in research and development to create AI models that can analyze vast amounts of environmental data. These models should be designed to provide actionable insights and predictions.
Once you have your AI tools, forming partnerships is the next critical step. Collaborate with governments, NGOs, and private companies. These partnerships can provide the support, data, and resources needed to scale your solutions. Moreover, aligning with these organizations can help in gaining credibility and trust.
Securing funding is also essential. Look for venture capital and government grants that support innovative environmental solutions. Venture capital can provide the capital needed for early-stage development, while government grants can support projects that have a significant public benefit. Highlighting the potential environmental impact and financial viability of your solutions can attract investors.
Implementing effective marketing and outreach strategies is crucial to ensure your target audience is aware of your solutions. Utilize digital marketing, social media, and public relations to create awareness and drive adoption. Demonstrating the real-world impact of your solutions can help in gaining traction.
Building a strong, multidisciplinary team is also key. Your team should include experts in AI, environmental science, business development, and policy advocacy. A diverse team can bring different perspectives and skills to the table, which is crucial for addressing complex environmental challenges and driving innovation.
Staying updated with the latest research and trends in both AI and environmental science is important. Continuous learning and adaptation will help your startup stay ahead of the curve and innovate effectively. Regularly attending industry conferences and workshops can also help in networking and staying informed about the latest developments.
Now, let's talk about how you can make money with this startup. One revenue stream could be selling AI-powered environmental monitoring systems to governments and corporations. These entities have a vested interest in maintaining environmental compliance and improving sustainability.
Another revenue stream could be offering subscription-based services for real-time environmental data and insights. Businesses and organizations can use this data to make informed decisions, comply with regulations, and enhance their sustainability efforts.
Additionally, you could provide consulting services to help companies implement AI-driven environmental solutions. This can include everything from initial assessment and planning to the deployment and management of AI systems.
By offering a combination of products, services, and data, your startup can create multiple revenue streams. This diversified approach not only maximizes financial returns, but also ensures a stable and sustainable business model.
By following these steps, aspiring entrepreneurs can create a business that not only offers significant financial returns, but also makes a meaningful contribution to environmental sustainability. The combination of AI and environmental solutions holds great potential for creating a positive impact.
If you're inspired by this idea, think about how you could apply these steps to your own projects. Share your thoughts and ideas with us on social media, and let's continue this conversation. Don't forget to subscribe to our podcast and follow us on Twitter for more insights and updates. Welcome back to our Stay Connected segment, where we address some of the intriguing questions from our listeners. Today, we have two questions that resonate deeply with our recent discussions. The first question comes from Sarah in Chicago. She asks, with the recent market rotation, how can individual investors take advantage of the shift from megacap to small-cap stocks?
Great question, Sarah. Individual investors can start by researching small-cap stocks with strong growth potential and lower P/E ratios. Platforms like financial news sites and investment apps can provide valuable insights. It's also beneficial to follow us on Twitter for live updates about new trades and investment opportunities. We often find small-cap stocks with at least 50% upside potential and take swing trades in ETFs when we see a good setup. Also, our episode Navigating New Frontiers, AI Innovations, Investment Trends, and Global Market Dynamics covers strategies for leveraging market shifts.
Our second question is from Emily in San Francisco. She asks, how can AI help improve investment decision-making for individual investors?
AI can significantly improve investment decision-making by analyzing vast amounts of data to identify patterns and trends that might be missed by human analysts. AI tools can provide real-time insights and predictions about market movements, helping investors make more informed decisions. For instance, AI can help identify undervalued stocks or predict potential market downturns. If you're interested in how AI is transforming finance, check out our episode AI and Finance Revolution live from the heart of innovation, New York City.
Fantastic! And for those who want to continue this discussion and not miss any of our episodes, where should they go?
To ensure you never miss an episode, subscribe to us on Apple Podcasts or Spotify. Your subscription helps us climb the charts and reach more listeners, expanding our community of finance and AI enthusiasts. Plus, it's the best way to stay updated with our latest episodes and the evolving world of finance and AI.
We also want to hear from you, our valued listeners. Your feedback helps us improve and tailor our content to your interests. Please let us know your thoughts by commenting on our social media posts or through the contact form in our show notes. Thank you to everyone who has joined us on this journey. Your curiosity and engagement are what drive us forward. Stay connected, keep exploring, and together, let's uncover the future of finance and AI.
We hope you found today's discussion insightful. As always, our aim is to provide you with the most up-to-date and relevant information in the world of finance and AI. However, please remember that the content discussed in this podcast is for informational purposes only and should not be taken as financial advice. Always conduct your own research or consult with a qualified financial advisor before making any investment decisions.
We would like to acknowledge the sources that contributed to today's episode. The following news articles were referenced:
Yahoo Finance, Reuters, MarketWatch, CNBC, The Wall Street Journal, The Verge, Business Insider, Bloomberg, Investing.com, Financial Times, CNN, Forbes.
We want to thank these sources for their invaluable information that helps us bring you the latest and most accurate news in finance and AI. For more details and the full articles, please check our show notes for links to these sources. Copyright 2024 financefrontier.com. All rights reserved.